Exchange-traded funds, ETFs, are investment funds that are traded on stock exchanges. They have gained popularity due to their flexibility, cost-effectiveness, and ability to provide diversified exposure to various asset classes and sectors. ETFs offer several advantages. They provide diversification by exposing investors to a broad range of assets within a single fund. ETFs are highly liquid, as they are traded on stock exchanges, allowing for easy buying and selling. They are cost-effective, often featuring lower expense ratios compared to mutual funds. ETFs also offer transparency, with holdings usually disclosed daily, providing clarity to investors. Additionally, the in-kind creation and redemption process helps minimize capital gains taxes, enhancing tax efficiency. While ETFs have many advantages, they also come with certain disadvantages. Trading costs, including brokerage fees and bid-ask spreads, can add up with frequent trading. ETFs are subject to market risk, meaning their value can fluctuate with market conditions. Tracking error may occur, causing the ETF's performance to deviate slightly from its underlying index due to fees and other factors. Some ETFs, like leveraged or inverse ETFs, can be complex and carry additional risks. Additionally, the ease of trading might lead to overtrading and short-term speculation, which can be detrimental to long-term investment performance. ETF liquidity can be assessed by evaluating its average daily trading volume and bid-ask spread. High trading volume and tight bid-ask spreads indicate good liquidity, making it easier to buy and sell shares without significantly affecting the ETF's price. Large trades, however, can impact the ETF's price and market dynamics. ETFs are known for their tax efficiency, primarily due to the in-kind creation and redemption process, which minimizes capital gains distributions. Investors only realize capital gains when they sell the ETF shares, allowing for tax deferral. Compared to mutual funds, which often distribute capital gains annually, ETFs offer a more tax-efficient investment vehicle. ETFs provide broad market exposure, allowing investors to construct diversified portfolios that reduce single stock risk. For example, a portfolio consisting of an S&P 500 ETF, a total bond market ETF, an international developed markets ETF, and an emerging markets ETF can provide comprehensive diversification. ETFs offer numerous advantages, including diversification, liquidity, cost-effectiveness, transparency, and tax efficiency. However, they also have disadvantages, such as trading costs, market risk, tracking error, complexity, and potential overtrading. By evaluating the costs, performance, liquidity, and tax efficiency of ETFs, investors can make informed investment decisions and optimize their portfolios.